the world blew up in 2008. The world is now entirely about the management of the debts. That is everything now. And there are two ways for that to happen. If we didn't do quantitative easing in 2008, 9, 10, 11, all of that stuff, the world would have burnt and destroyed in the manner that you thought, which is like the Argentina collapse, the Cyprus collapse, this huge destruction. What we chose was a glide path.
Raoul Pal, the CEO of Real Vision and the company's founder, shared his observations on the Great Economic Unwinding, a word used to describe the imminent financial collapse that is taking place. Raoul can make connections and give investors and market watchers alike significant information thanks to his strong understanding of macroeconomic trends. The world is on the verge of a monumental debt disaster, Raoul says in his opening statement. In an effort to prevent economic collapse in the wake of the 2008 financial crisis, the central bank has tried to stabilize the situation. By pouring trillions of dollars into the economy through quantitative easing, central banks have produced a risky environment marked by excessive risk-taking, artificially inflated asset prices, and soaring corporate and sovereign debt. Ravel claims that this enormous debt load is about to start off an unstoppable domino effect that will eventually cause the great unraveling. He stresses the interconnectedness of the world economy, saying that when one domino falls, it's just a matter of time until others do the same. Let's listen to Raoul Pal as he discusses challenges related to high debt, population productivity, and economic growth. Take a back seat, click like, subscribe, and take pleasure in the video.
Is it something I call the magic formula? Magic formula is economic growth. Economic growth is driven by three factors and three factors only at long-term level, aside from just the normal business cycle ups and downs. Population growth. The more population you have, the more your economy has activity. So population growth, population shrinking the entire Western world. The only way of offsetting that is immigration. But we talked about the fact that the workers are angry, they can't get wage rises. There is less of a desire to have immigration than there was maybe 20 years ago. So most countries have started to restrict immigration. Fine. So there's no way of solving the population side. The next part of the magic formula is productivity. That's how much output each of us can generate for the economy, and that becomes more efficient. Problem is, it seems to be a function of demographics too, and productivity has been declining since the 70s. Well, actually since the 50s. So productivity is going down. The population is shrinking over time. So the answer was debt. The answer all the way through this equation from these people who were sold the American dream back in the 1950s, the baby boomers. They're listening to Elvis Presley, getting into the Beatles. They're like, let's go, the American dream, I'm going to get rich. But as we pointed out, their wages never went up. But because there were so many of these people, they competed for houses, and houses went up. They invested in the stock market went up. Everything, all assets got more expensive because of their demand. So they did the rational thing, which is I'm just going to borrow money. And the difference between the rise of the assets and their wages is essentially what the debt was. The debt side of the equation is what the government's done too, because GDP is declining. The trend rate of GDP keeps going down. If you see the Chinese economy, and what happened is they did the same. They had population coming in, productivity probably rising, but then they massively borrowed money. So they had the fastest growing economy in the world for a long period of time. Leverage gives the illusion of growth, but obviously it has a payback later. And this is the payback we've got now. The leverage that the baby boomers took on, their governments took on, and the corporations took on for all of this issue is what we're dealing with now. So wages didn't go up, assets went up because they were competing for them, like you're competing for scarce resources of people right now. But when you put 76 million people in, the housing market goes up. The stock market goes up because they start pension plans and stuff like that. So the difference is debt. And that was okay. Although we were all starting to look at this saying, whoa, this is now getting absurdly debt laden. The government's 100% of debt. The private sector's 100% of debt. Households are 100%. of GDP and debt. It's like, well, this is out of control. Then 2008 comes along. And that is the debt crisis. I mean, every fucking bank blew up. I mean, everything blew up. It was a complete, total collapse. And that rolled on into Europe in 2012 when the governments, Spain, Italy, etc., blew up. And all the banks in Europe blew up.
Raoul emphasizes that businesses are more indebted than ever, with some industries, like the energy sector, already displaying warning indications of trouble. Defaults and bankruptcies will increase as these businesses struggle to pay off their debt. He also makes note of the fact that the United States, Japan, and Europe are all dealing with previously unheard of debt levels. The bond markets will face intense pressure when these governments are unable to pay their debts, which will result in increased interest rates and worsening economic conditions. Due to the exposure of banks and financial institutions to both corporate and public debt, the system will be put under strain, which could result in a global banking catastrophe. Let's watch the remainder of the video as he discusses global wage levels and hyperinflation.
Hyperinflation is when you issue more money to pay your debts, and it comes in an endless cycle because you're not generating GDP growth, so you just keep printing money. So an excess of anything, in extremis, everything becomes worthless. So if you're thirsty and you've come out of the desert and somebody gives you a bottle of water, you'll pay pretty much anything for it. If somebody's there with 1 million bottles of water, what's a bottle worth to you? Almost nothing. Once you've had the first one, right? So anything in excess supply, just supply and demand. Too much supply of currency, the value goes down. So what happened in Germany is they had these gigantic, impossible to pay debts to the West. So they printed as much money as possible. That blew up spectacularly. Prices rose millions of percent. And every time you got paid as a German citizen, that fistful of notes barely bought you a loaf of bread one day and half a loaf of bread the next day, and then nothing at all until you have wheelbarrows full of cash. And we've seen this in Argentina. We've seen it in Venezuela. We've seen it in plenty of countries. We just saw it in Lebanon recently as well. That's a total collapse of the value of a currency. Okay, so therefore, all of your productivity as a human is devalued as well because you can't buy anything. So you end up having to ignore currency and barter. And we've seen that in many places as well, because the value exchange of a currency in the middle, because it falls so fast in value, it's a nightmare to deal with. And it's a total destruction of wealth, except those who own assets. Real wages have not gone up versus prices.
Okay. Meaning
so prices rose more than wages. So if you look at peak, I don't know what peak wages were, but let's say they were 6% last year, year-on-year wage growth, but peak prices were 9%. So people actually got poorer, which is why we've got a recession going on, because everybody lost purchasing power versus just basic goods. By every indicator I've got, we're in a recession already. And it will become more abundantly clear. The other thing I think is a point that's also important is we need to think about total aggregate demand within an economy. And who are you giving those increased wages to, right? So yes, you are paying more for scarce labor, certain skill sets, expertise, whatever. But when the labor force participation rate is only 65%, you have to average that over 65% of the economy, not 100%. And that's the function of demographics. So there's a whole bunch of people who are retired whose wages can't go up, which is retirees, which is basically that 35% is that bucket plus people who've opted out. So you actually reduce it by that. And the labor force participation rate is actually a function of the birth deaths rate forward lagged 30 years. So what we know is, we know in the future that there's going to be less and less people in the workforce, which is interesting. And it actually mirrors inflation, GDP growth, everything's driven by this monumental demographic issue. So yes, you're paying up for wages, but your margins have gone down anyway because the other costs of input. So real wages for everybody have actually gone negative, massively negative, which is why everybody's feeling the pinch.
The risk of financial stress in developing and emerging market countries is growing as a result of the steep slowdown in global growth and the high global interest rates. Global growth is expected to slow from 3.1% in 2022 to 2.1% in 2023, according to the most recent assessment on global economic forecasts from the World Bank. The growth rate in countries other than China is forecast to drop from 4.1% last year to 2.9% this year. These projections represent widespread downgrades. According to A.J. Bunga, Group President of the World Bank, employment is the surest method to eradicate poverty and promote prosperity, and slower development makes it far more difficult to create jobs. The majority of economies have so far only experienced minor loss as a result of the recent banking stress in advanced economies, but they are now sailing in dangerous waters. 1 out of every 4 Ms has effectively lost access to global bond markets as a result of the tightening global credit conditions. For Ms with inherent weaknesses like poor creditworthiness, the squeeze is particularly harsh. These economies are expected to grow by less than half as much in 2023 as they did a year ago, putting them extremely exposed to future shocks. Ender McGill, Senior Vice President and Chief Economist of the World Bank Group, stated that the global economy is in a vulnerable position. It is far from dynamic enough to end poverty, combat climate change, and restock human capital outside of East and South Asia. Less than 1/3 of the rate it grew in the years prior to the pandemic will be achieved by trade growth in 2023. Growing debt pressures are a result of increased interest rates in emerging markets and developing countries. Numerous low-income countries have already entered debt distress due to budgetary inadequacies. The finance requirements, however, are much higher than even the most optimistic estimates of private investment, making it impossible to meet the Sustainable Development Targets without additional funding. According to the most recent predictions, the simultaneous shocks of the pandemic, the Russian invasion of Ukraine, and the significant slowdown in the context of challenging global financial conditions have inflicted a lasting blow to development, in Ms, one that will last for the foreseeable future. Economic activity in these economies is predicted to be around 5% lower than what was anticipated on the eve of the pandemic by the end of 2024. The damage is severe in low-income countries, particularly the poorest. In more than 1/3 of these nations, 2024 per capita incomes will remain below 2019 levels. This sluggish rate of income development would further entrench extreme poverty in many low-income countries. What do you think about the current predictions for the global economy? Don't forget to hit the like button, subscribe, and enable notifications for new videos. Share your thoughts in the comments box below. Thank you for watching.